Good day. My name is Laksh Behl. Welcome to Behl's Business Broadcast. We are going to look at the top news of the week related to business and finance and how they apply to your business in this live stream. Then we're going to talk about the top 6 myths that are being perpetuated by experts. But let's start with today's top news headlines. And as usual, we're going to use Perplexity to look at today's top headlines. So let's get started. First things first, Bitcoin ETFs have lost $870 million as crypto enters a bear market. Now, crypto has entered a bear market, or at least it looks like it's going to enter a bear market, despite the positive news that we were expecting just a month ago. And this goes on to show you over the short term, nobody really has a crystal ball. Nobody really knows what's going to happen over the short term. Over the long term, however, things look positive for crypto, AI, and your business if you are positioned correctly. So we'll talk about that. But let's look at the Bitcoin chart right now. And as you can see, this right here is the Bitcoin USD chart. And yeah, the headwinds are pretty obvious right here. Bitcoin topped out on October 4th at about $125,000 right there. And then since then, it has been falling and has fallen to about $94,000 right now. This is actually surprising because the last time I checked, which was just a few hours ago, it was hovering at $98,000. So it appears to be in a bit of a free fall. And if you believe in the support and resistance or volume profiles, the next level of support, if it crashes beyond this level, is going to be somewhere around here, which is the $83,000 level. But if you scroll back down further beyond this obvious chart, because again, markets can go way further than you think they can. Prices can tank way harder, especially in crypto, than you think they can. And that is likely going to happen. We have serious support expected around the $60,000 to $70,000 range. So I would not be surprised if Bitcoin goes short term to this range or even further below. If you look at the weekly candles, which gives us more of an idea of what happened, and this was the bull run. This was the entirety of the bull run for this crypto season, right? It began somewhere around 2022, end of 2022, ran up for 3 years. Actually, that's not bad, and ran up from about $15,000, $16,000, let's say $16,000 roughly here, all the way to $125,000 here. Now, obviously, you would have no way of knowing that this would not continue its relentless march to $250,000 or $1 million even. What you do know for a fact that it appears to have turned down. Now, can it go down from here? Yes. Can it go back up from here? Yes. But that would depend more upon the macro headwinds or tailwinds, depending upon how the interest rates play out, depending upon how the federal balance sheet plays out, instead of just wild speculation from investors. So experts, as usual, know nothing, and I know nothing about the short term. I'm prepared for either situation, either contingency. If it turns down, so be it. If it turns back up, so be it. You cannot really predict short-term noise, if you will, compared to long-term signal. Moving on. MicroStrategy's strategy related to Bitcoin holdings remains unchanged despite transfer rumors. So this is a long-term investor, someone who has been investing in Bitcoin. Michael Saylor, right? He's been investing in Bitcoin, whether it was $16,000 or $60,000 or $100,000 or back to $25,000. They just keep on investing. And Strategy's holdings have actually fallen from 484,000 Bitcoin to 437,000 Bitcoin, but official dashboard showed no change, maintaining total holdings of 692 Bitcoin as of Friday. So the discrepancy might have resulted from internal wallet transfers. On the whole, though, MicroStrategy, as always, remains bullish on Bitcoin. And as you've seen, they've been doing exceptionally well compared to other stocks that actually produce a lot of real value in the world. All they do primarily is hold Bitcoin. And that tells you something. They're on the verge of something big. They might be on the verge of something big. Now, this news, I always talk about this interstellar object, 3i Atlas, which experts are now debating about whether it's an artificial object, which would have huge implications. Is there artificial intelligence out there, or is there intelligence out there outside of Earth, or is it just natural gravity based, emission based, momentum based, Newtonian physics based trajectory? And now Harvard and NASA are basically disagreeing with each other and taking shots at each other, and they don't seem to agree. What I really want you to take away from this piece of news is nobody really knows what's going to happen in the future. Nobody really knows the exact truth of everything. Experts are often wrong and often at odds with each other. So if you trust one source of information over another, and if you're not agnostic about what you trust, you're probably going to lose out in your business. Okay, moving on. Here's another piece of evidence that tells you that experts are often always wrong, and science, even settled science, is only a matter of time. So biologist has now proposed a new theory that is challenging 6 decades of evolutionary science, which seems to have been settled and at least is taught as settled science in high school and middle school books, right? Evolutionary theory seems to be well established. And there was this whole thing in Friends, right, the TV show, where Ross is so confident about evolutionary theory, and then his friend, I think her name is Phoebe, she comes around and she says and questions him and challenges him. She says, "Are you absolutely sure?" And he's like, "Absolutely, I am." And then she says, "How do you know that you're not wrong?" A few centuries ago, scientists were absolutely sure that the Earth is flat, and now everyone agrees that they were wrong. So are you going to not even concede that there's a slight tiny amount of chance that you're wrong about whatever you think evolution is, or how you think it played out? And he concedes, and then it leads to a hilarious situation where she loses all respect for him because he conceded. But the point remains, nobody really knows what's going on, and we can only arrive at truth as you can observe it right now. That does not mean it's universally applicable. That does not mean it will apply in the future, or it did apply in the past. In other words, strategies that worked for your parents, for your grandparents, are not likely to work for you today because the economic situation has changed. Whether it's saving, business, or finance, or investment, whatever it is that you're taking advice from someone else on, if they're already at a different level, or if their strategies worked at a different point of time, they're not likely going to work for you in most cases. You're going to arrive at your own conclusions about how things work, and even your conclusions are going to prove wrong over a long enough period of time. So it's just a set of situations that works for a small period of time, then eventually over time, it just ceases to work. And that is the absolute truth. And as you can see, evolutionary science, it's supposed to be settled science, and now we have a biologist who is proposing a theory that challenges it. Now, I don't know if this theory becomes the acceptable theory over the long term in the future. I don't know if something else takes over the current established theory of evolution over the long term. What we do know is everything gets challenged over time. Newtonian physics, even though it is so solid at a certain level of scale, right, for everyday objects or for even celestial objects, it seems to be absolutely true. But it breaks down on a very tiny level when you go to quantum physics. And then it breaks down on the macro level when you go on extremely large distances or extremely high velocities. So nobody knows everything. And all hypotheses are based on a set of circumstances holding together. And when those circumstances change, theories change. So don't rely too much on what you know, and don't rely too much on what experts know. Rely only on what seems to work right now under these particular conditions. This is why, if your business grew from $1 million to $10 million using a set of principles, then you neither have the same set of principles, nor the same set of challenges, nor the same set of conditions going from $10 million to $25, $50 million. You have a new set of challenges now. You have a new set of conditions now that you need to actually take into account, and what brought you to this level is not going to take you to the next level. This is why it's important to consult people who have just recently solved the same problems that you're facing right now. Crypto marches on. Despite the bear market being pretty obvious right now, at least short term, Binance is now accepting BlackRock's $2.5 billion tokenized fund as a collateral. And here's the big thing that you need to understand. This is this is one of the big things that has actually brought together institutional trading and crypto trading. This does not happen frequently. It hasn't happened very frequently in the past. But as we go along, it seems that this will continue to happen more and more frequently as we go along. Real world implications of crypto or of blockchain technology and traditional finance merging itself with blockchain technology, which means the blockchain adoption continues even though we have headwinds for the time being, or seeming headwinds for the time being. Like I always say, the political solution to all sort of unrest is A, lying, and B, money printing. And this is proved by Trump advancing $2,000 tariff dividend with income cap. Now, he's advancing it. It's not set in stone, and it may not happen for a very long time. Remember, markets can remain irrational far longer than you can remain solvent. So don't depend upon this. But if this happens, we may just have tailwinds for crypto, for stocks, for small altcoins, for small businesses, for literally everything. We may have another situation where the gravy train's back on, the party starts again, and we have the same post-COVID situation with the stimulus checks. And that seems to be one of the inviolate truths. Politicians would either lie, as Trump just did, when he claimed that US does not have an inflation-related problem. Trump claimed that prices are actually going down, which is demonstrably false. Trump claimed that prices were going up when Biden was in the White House. That's not true. Prices have gone up ever since Trump took office, and they were also going up when Biden was in office, and they were also going up when Trump was in office, and they were always also going up when Obama was in office, and the cycle continues. Everyone blames their predecessor, but here Trump has actually made an absolutely false statement in terms of prices coming down or even holding steady since he took office. That's absolutely not true. However, there is growing discomfort as evidenced by last week's gubernatorial elections, where Democrats essentially demonstrated how people are dissatisfied with the GOP's performance. And in most cases, that dissatisfaction is a consequence of prices going up. There are political differences, but at the end of the day, what hurts most people, most of all, is their own living conditions getting worse. That is what I think drives all political opinions. Whatever you are affected by or impacted by drives your political opinions. So if you are fired because a foreigner was hired in your place for a lower salary, then of course, legitimately and understandably, you have a problem with H-1B immigration, for instance. That drives your political philosophy. Similarly, if you are feeling the pinch of rising prices and lower discretionary income, and even though you're becoming more financially disciplined, things are becoming harder for you because the income is not going up, or you might have lost a job, or someone in your household, typically your spouse, might have lost their job, especially thanks to AI. And that seems to drive a lot of political opinions for a lot of people. What personally hurts you drives your political opinions. And in this case, you are seeing that people are dissatisfied with the GOP's performance. Why? Well, things are harder now. And the one way politicians always have, the one spigot that they can always turn, is printing money, which is what seems to be what Trump wants to do with this $2,000 tariff dividend. How it goes, we'll see. Either way, if you're a business owner, if this happens, it's going to be a great time for you. If you're an investor, if this happens, should be a great time for you if you are positioned well. And in our previous streams, we've talked about how to position yourself well to take advantage of this $2,000 tariff dividend, or whatever happens in the future that is caused by money printing, right? As a consequence of money printing. And yet another piece of evidence that the political solution to all sorts of problems seems to always be stimulus packages. And so now Japan is also seeking a stimulus package exceeding $92 billion. Why? Because we can't have deflation for whatever reason. We can't have prices going down, and we can't have people being completely devastated by the lack of liquidity. So what do? Stimulus. That's what you do. Okay, but what we do know over the long term is that things are relatively simple. When money printing happens, hard assets tend to go up in value. Real estate, SPX, Bitcoin, gold, those are the hardest assets, they tend to go up in value. And this is actually in line with what we have here. So there are two things to take away from it. Bit Digital reports Q3 profit topping expectations because experts did not expect Bit Digital to have profits in the third quarter of 2025. Another piece of evidence that experts are almost always wrong. Another piece of evidence that despite the headwinds, Bitcoin mining, crypto mining, and cryptocurrencies and blockchain technology in general advances on. That's your long-term takeaway. Think long-term. Don't think in terms of 2 months, 3 months, 6 months. Think in terms of where we're going to be 50 years from today, 25 years from today, even 10 years from today. That should be your time frame if you're thinking about this correctly. AI virtual patients enter medical training. Yet more evidence of AI both taking jobs, and we'll talk about this today, how this applies to your business, whether it's a small business or a large business or a medium business, and also AI just continuing its relentless march. Don't worry about the short-term headwinds. I mean, if you have invested in NVIDIA or Bitcoin, you might want to adjust your portfolios, right? That's really up to you and your financial advisors. But what I'm saying is long-term, AI continues its relentless march. 97% of listeners cannot tell AI music from human-made. What does that tell you? 97% of people cannot tell AI music from human-generated music. So you thought being in a creative profession like music production would keep you safe from the onslaught of AI? Think again. You're wrong again. If you thought that music production or photography or cinematography or any other creative profession like creative writing is going to be spared the onslaught of AI, you're absolutely wrong. The relentless march continues, the training continues, the investments continue. There is nothing that will slow that down. And human beings, listeners, consumers, cannot tell whether that music was generated by AI or created painstakingly by a human creator, by a human artist. They really can't tell. And AI is only getting better. Milestone has raised $10 million just to measure AI coding tool ROI. So if you are using AI for coding within your business instead of human beings, then how much effectiveness do you gain out of that? That is being measured. You know the consequence of that? People who are in coding, people who depend upon coding, people who are actually coders, that's their profession altogether, are sooner or later going to be the victims of this onslaught of AI in the coding field as well. So we have medical field, coding field, professional fields of all kind, creative fields of all kind being taken over by AI. Do you think that's going to lead to job cuts? Do you think if your business is not taking advantage of AI, you have some sort of disadvantage, especially against competitors who have already begun taking advantage of AI in their businesses? We need to talk about that. Because despite the headwinds, Anthropic, the company that owns Claude, is now planning a $50 billion investment in US AI data centers in, where? I think it was in Texas. Anyway, somewhere in the US, right? They're investing $50 billion, not because they think that AI is a fluke, but because they think it's going to keep getting better. They're going to keep improving the technology. The customer base is keep expanding, which means if you're not using AI, your competitors are, and you are getting left behind. So that's the top news from the week, but now we talk about how to implement this stuff within your business. So let's get started. The first thing we have to talk about is inflation. And I always say that inflation is literally a one-way street. You really don't know inflation will ever go down because politicians don't want that. Now, inflation can go down, and they really like a 2% inflation rate, right? They hate the 4%, 3% inflation. Okay, this is inflation. They hate it. But the prices never come down, okay? Prices just keep going up, and then the growth slows down, and then it goes back up. So when inflation is low, this is low inflation. The prices are still going up. This is where inflation is low. And the inflation is high. This is high inflation right here. Prices never come down. So if you're a business owner and if you're working about, oh, how do I fight inflation without increasing the prices of my products or services, you're already fighting a losing battle. You can try to optimize by getting better terms with your suppliers, but your suppliers are also subject to the same market forces that everyone else is. So your suppliers are paying more for their services and their ingredients and their raw materials. How are they going to give you better terms? Or how are they going to give you cheaper prices? It's just not going to happen. If you try to arrange your business and extract more efficiency in your operations just to get some sort of a window where you can hold back price increases, that's only going to work for a short period of time. Eventually, everything gets so expensive that you either go out of business or your margins get killed and then you go out of business, or you increase your prices. If you're a business owner trying to fight inflation without increasing the prices of your business, of your products and services, you're already fighting a losing battle. You're already fighting a losing battle unless you increase prices. And the question you need to ask is, why? Why do you not want to increase the prices? Number one, you have fear that customers are going to go away. That's a very bad position to be in. If you're afraid that your customers will go away, if you just keep increasing your prices to keep up with the inflation, then you don't really have a business. You have something of a structure that is standing on a pile of sand. Why? Because customers know that prices are going up universally. They're paying more for clothes, they're paying more for housing, they're paying more for gas, they're paying more for cars, they're paying more for transportation, for everything, for groceries, for insurance, everything. They're paying more money for everything. If you want to keep your prices stagnant, the question is why? Oh, I have this reputation of being reputable. Well, Costco has this reputation, okay, and people love to cite Costco. People are like, Costco still sells rotisserie chicken for $5 or $6 a chicken. And they still sell hot dog for $2 or $1.50, whatever, right? Despite so much inflation. But what you need to understand is for Costco, its strategy, it's a loss leader. Costco is losing money on rotisserie chickens or on hot dogs in most cases. That would be my assumption. I haven't looked at their numbers, but that would be my assumption. They're losing money. Why are they losing money? Because they make a fuck ton of money on the other products they sell. They sell everything at a bulk, in bulk, right? Everything is $10, $20, $30 at Costco. You want paper towel? $20. You want water? You want sparkling water? $20. Everything is $20. Sure, the unit economics make a lot of sense for buyers and for sellers, but Costco is selling a lot of product. Costco is able to keep prices low, and their margins on everything else are kind of contained to 10 to 15%. At least as per my understanding. But that is because they sell a lot of product. They move a lot of product, and their membership fee, the $60 or $130 that you pay up front for an executive membership or a regular membership, they actually cover a lot of losses. So they can afford to lose a little bit of money on chicken and hot dogs while you buy the rest of their products, and they more than make up for that loss from the back-end sales. Do you have that business model? Great. You can keep the prices low on your loss leaders. That's a business strategy. If you have a loss leader, keep the prices low. But if you're just worried that, oh, I cannot really increase my prices because my customers are going to abandon ship, then you really don't have a strong business to begin with. It's probably better to just let those customers go, and maybe, just maybe, your assumptions are wrong. Maybe you're wrong. Maybe customers will stick to it. We saw an example of a small business owner who posted on Reddit how they increased their prices, and then someone came back with, yeah, that was way overdue, bro. And most customers did not object whatsoever. They just were like, okay, prices go up over time. They have to. Don't worry about the price increases, because how long are you going to sustain this? Operational efficiency? Well, you buy yourself a few months to a few years. Yeah, months to years. That's all you can really do. What about suppliers? Well, suppliers are subject to the same market forces that you are, that I am, that every one of us is. They cannot override the economic conditions. If inflation is a permanent thing and prices just continue to go up, and we are not going to have deflation as we just saw with Japan. Japan does not seem to want deflation, right? They want bold spending. Why do they want bold spending? They want bold spending because they don't want deflation. They don't want prices going down and GDP to contract. That is an economist's worst nightmare. Why? Because it's also a politician's worst nightmare to say, oh, our GDP contracted, but we are actually on a positive track after all. That's one thing most people would not understand. That's one thing that most politicians would never, ever say in their entire careers. So that's what we've got going here. Okay, the next thing we want to talk about is AI. Is it too expensive? And should you use it in your business? Here's what you have seen. Here are the factors that you need to consider. First, AI onslaught continues. And by onslaught, I mean improvements and investments. They continue. Which means it gets better and more powerful over time, or in other words, capable over time. That's the first thing you know. The second thing you know is your competitors are at least considering it, if not using it. If they're not effectively using it yet, they will figure out how to use it. If you don't use AI, then it becomes sort of an anti-moat, right? Warren Buffett talks about having a natural moat for your business. What can you do that other businesses can't easily replicate? That's your moat. Well, right now, if you're not using AI, what you have is the opposite of that. You have an anti-moat. Why? Well, like I said, your competitors are likely to be already using it, or they will hire someone who will know how to use it, and they will cut down on their expenses. Third, you already know AI is taking jobs, which means, what does that mean for your business? Well, what that means for your business is that your competitors are lowering their annual expenses. Every single one of them? Maybe not. Some of them, the smarter ones, yes. The ones at the cutting edge, the bleeding edge, the innovators, the big ones, they definitely are going to start using AI even if they haven't already started. They're going to use AI to let go their worst performers, at least, the worst 10% of their performers. That's a significant amount of money saved. If you have a business that makes $100 million in top line and you have $35 million in just HR costs or human resource costs, basically salaries and contracts and wages, if you can cut down 10% on that, that's $3.5 million. But that $3.5 million isn't exactly 3%. In terms of EBITDA, in terms of takeaway, right? So if that business was, let's say, $100 million top line, and then they were doing about $35 million in expenses and about $15 million in locations and about $10 million in advertising and about $10 million in some other expenses, right? Software, consulting, so on and so forth. And so the takeaway was what? 30 million, right? That's the EBITDA. Well, now, if you can cut this cost by 10%, right? If you can cut this cost by 10%, then you're literally adding 10% or 12% to the bottom line. It's not 3% of the top line that matters, it's bottom line that matters to most small business owners, small and medium business owners, even large business owners. At the end of the day, you cannot eat revenues. you can really only eat from what is left after all your expenses are taken care of. So AI is taking away jobs, and your competitors are likely going to fire their worst performers and just have AI take their position. And you've seen this happen with coding, with design. Okay, coding, design. You've seen this happen even in medical industry. That's beginning now. You've seen this happen with, and we just showed you all the news related to that, right? You've seen this happen with, what else? With creative tasks, music, images. In fact, deep fakes have become so good that public advocacy groups have started advocating against Sora and other models that create deep fakes, and have called for ethics guidelines, which means they are almost virtually indistinguishable from actually having someone who went on film and said something. In a short period of time, in a couple of months, maybe a couple of years, you would not know if I'm actually here or if it's just a deep fake of me doing this live stream, right? And everything is getting done by AI. So if AI is too expensive for your business, no, it's not, because starting to implement AI for just $20 a month, $100 a month, $1,000 a month is not a huge burden on your business. But if you don't have the time to learn it yourself, which if you're a business owner and a business leader, you may not, you may want to hire someone, or at least have someone on your team start looking into this and start figuring out how you can cut down on your expenses using AI. Remember, numbers are agnostic. Okay, I'm going to write it down here. Numbers don't care. The old wisdom, a dollar saved is a dollar made, right? Numbers don't care. They are agnostic, completely agnostic. They don't care how those numbers were produced. Your bank does not care how your bank balance changed, as long as you're not doing anything illegal, in which case courts get involved, of course. But if you're doing something that is completely legal, and if you can fire, let's say, the worst 10% of your performers, and instead hire just one person who can do all their jobs, a highly paid A-grade player, right? A players, plus AI, plus tech stack. If you can do that, you're saving yourself a lot of money. In fact, for my own businesses, I try to hire as few people as possible in full-time positions. But when we do hire, we only hire A players, people who are really good at what they do. And we only hire them if tech cannot automatically do everything that they're doing. You have to understand, a lot of businesses that became super big did not become super big because they hired the best people in the world. Unless you're talking about NVIDIA, that's a different story. And then, two, they focus on hiring the A players, right? A lot of businesses become big just by replicating models that literally anyone can operate, like franchise businesses, Starbucks, Pizza Hut, Domino's, McDonald's, Burger King. You don't have necessarily A players working at their retail outlets. You have training systems. And now, as we move towards tech taking over a lot of stuff, how long will it be before you think there's going to be a chain of restaurants or fast food restaurants or fast cafes, fast casual dining places that just have robotic arms taking care of serving the customers? McDonald's has had these panels where you just walk up to those kiosks and place your order. You also have apps. Pretty much with every business. Panera Bread, same thing. They've got a tablet where you go in, punch in your order, and just pay using a credit card. How hard do you think it's going to be for one of these businesses to replace the employees actually preparing your drink and have a robotic arm do it? You know what? Robotic arms are already preparing drinks. I was in Thailand last year, and I think it's called Taobao. I'm not sure, but Taobao is like an ATM, but for drinks. ATM for drinks, and it has a huge menu. You can customize how much milk you want, how much foam you want, what kind of milk you want, what kind of sugar you want, if you want any sugar or not. And you can get a frappuccino, a cappuccino, a hot drink, a cold drink, a soda, all of that from one single machine. So that is coming. You don't even need AI for that. It's just going to happen over time that more and more complicated dishes can get prepared by AI. We have AI cooking things, and it's just in its infancy right now, but it is coming. The onslaught continues. The bottom line is, if AI you think is too expensive or too fringe for your business or too indirectly, like not directly applicable to your business, then you are missing out and your competitors are going to take advantage of that situation. You can flip that, be the person who uses AI in their business, and be the leader within your local market or even in the wider market where you possibly cannot be a leader right now because you're not big enough. But you can use AI to build a moat around your business. At the very least, you should be using it because your competitors are, and they're going to reap the benefits. And will you fire people? Yeah, you're going to have to fire people. Eventually, most businesses are going to end up letting go some of their workforce. I'm just being harsh but completely honest. I see the writing on the wall. Most businesses will end up using tech stacks and AI-based workflows that will have them cut down their expenses, especially human-related expenses, wages, and contracts by a significant amount. Do you want to be left behind? I don't think so. Let's also talk about side hustles, because this is something that someone talked to me about yesterday. They wanted to start a side hustle. Their business was doing so well, they were really only spending a few hours on it every week. And they're like, should I do a side hustle? Maybe do some teaching, maybe do some training, whatever. I'm like, why do you want to do it? It's one thing you want to do it for your hobby, right? But if you're really thinking of side hustle for money, I think you're making a big mistake. You're making a big mistake because you're talking about diversification. Well, diversification works in a portfolio which you are either actively managing yourself or someone else is managing for you, or diversification works across industries, massive industries. You're talking about security here, right? I'm going to be more secure if I have two different sources of income. A lot of people think like that. I should have multiple sources of income. But if you want to be secure, invest some, in crypto, invest some in SPX, invest some in stock picks, maybe tech stocks, invest some in metals, invest some in real estate. That's true diversification. And even real estate, go outside of the US. You have US real estate, you have global real estate. Go into UAE, right? Go into Thailand, go into emerging markets. Same thing with tech stocks or other stocks. Go into the US markets, go into maybe London Stock Exchange, Hong Kong Stock Exchange, other markets, right? Emerging markets. That's your diversification strategy right there. You are going to be a lot more secure with that diversification strategy instead of wasting your time on a diversification strategy that does not work. Here's why. 80-20. We keep talking about it. 80-20. If you're already applying 80-20 and you only are doing 80% of the work, 20% of the work for 80% of the rewards, you're in a great, enviable position. Now you're saying, what do I do with your time? Well, amplify this 20%, okay? Apply disproportionation here. You really shouldn't even be thinking about growing, diversifying into another set of businesses until you get to a serious market share. Market share of TAM, total addressable market. Are you anywhere close to the total addressable market that you have? Can you take your business with more product lines, spend more time on product lines? That's where the big money is made, back end. Yeah? Can you expand your business with strategic alliances or joint ventures? Can you expand your business line to other countries? Your products and your services to other countries if you have really maxed out nationwide. There's a lot more to do in your business right now before you even get to touching a percentage of TAM. And if you have more time, just spend your time planning and dominating your own business, dominating your own industry nationwide, and then taking it deeper into the product line. So if you have 10,000 customers, okay, this is how the funnel works. If you have, people think the funnel is reversed, but let's look at the pyramid level of the funneling, right? 10,000 customers paying you, let's say, $1,000. Well, okay, do you have a $50,000, do you have a $5,000 offering for them? Do you have a $25,000 offering for them? Do you have a $100,000 offering for them? Okay, those are completely different offers, product or service or a combination thereof. Okay, if you have 10,000 customers here, maybe you have 2,000 customers here, maybe you have 400 customers here, maybe you have 80 customers here. Okay, just applying 80-20. It doesn't exactly work like that. This is a 5x more than a 4x, but you get the idea. Okay, you can just quadruple your revenue like that. And that's revenue. Remember, you've already paid customer acquisition costs for these 10,000 people. That customer acquisition cost is already paid for. So now all you have are variable expenses of selling these higher end products. Figure out how to build a deep backend that is going to give you the big, enormous advantage that you need in your business. Even if you can do surf scaling and keep acquiring new customers every single day, you also benefit from building out a backend, building out a relationship with your customers, because that is where branding happens. That is where long-term equity is built. That is where a truly sellable business is built. Can you just keep going? Can you keep going? Yes, you probably can keep going to a $500,000 products and $5 million products even. Will you have a lot of customers at those levels? No, not really. But you really need one customer at $5 million level to actually grow your revenue by 50%, going from just this level. Then, do you have alternative product lines? Because they all come with their own pyramids right there. Do you have alternative product lines? Can you bring your products to your competitors' audiences? Yes, you have strategic alliances and joint ventures with your competitors. Alternatively, can you bring your competitors' products to your own audiences because you don't have anything else to sell to them? In case you don't have anything to sell to them at this level, this level, this level, well, can you go into the market, find a competitor or someone else with a compatible business at a different price point and then work with them? Well, there's a lot of stuff you can do in your business, and side hustles are a waste of your time. You're doing the anti-80-20 by going side hustle. Or you're like, oh, might as well make 50 bucks an hour, you know, even though I can make 5,000 bucks an hour working in my own business and scaling it up. I'd rather only make 50 bucks an hour because at least I have a diverse source of income, you know, a secondary source of income if my business fails. If your business fails, it's not going to be all at once if it's already working. And if there are specific aspects of your business that seem to be challenging, you need to solve those challenges. And that's where your attention should go. That's where your time and money and energy should go. That's where your creativity and your insight should go, instead of starting another business which is going to have a whole set of new problems that you've already solved for one business that you've already got going for yourself. If you want security, if you want diversification, that works in your portfolio. It doesn't work on your incomes, you know, it works on your portfolio level. Build out a portfolio of investments that is diverse. You're worried about currency risks, go into other currencies in your portfolio. Okay, moving on to the next topic. Hiring people, is that a good thing or not? The first thing you have to understand is that people used to say, oh, people are the biggest assets in your business. Well, that's really just 2020. I'm just going to be very harsh, okay? I'm just going to be very harsh, and I'm going to tell you that that's just a 2020 way of thinking. Right now, the marketplace where your employers, that is presumably you, and your employees meet, those marketplaces are completely inefficient right now. Employees have demands, and those demands are basically keep up with inflation. They have reasonable and legitimate demands. Keep up with inflation. Wages should keep up with inflation. They want perks. They want time off, paid time off. This is all legitimate expectation from an employee. The question is, should you do it? Yes. If they are an A player, absolutely, do it. If you need an A player and if they are someone who fit that role, and if they're going to work for your company, pay them more than fair inflation wages. But for the most part, now, as we draw towards 2026, you don't need people. You need tech, you need AI, you need LLMs, and you need someone to orchestrate that. So this orchestrator, in many cases, is the A player that you need. People say, oh, hiring people is the best thing you can do. Hiring the best people in your business is the best thing you can do. And I agree. Hiring A players is the best thing that you can do in your business. Hiring just people for the sake of hiring, because we have 50 people working for us, we have 500 people working for us, is not going to work going forward. We've seen all sorts of evidence mounting for that. Living wages are going to continue to rise. The minimum wages are not going to satisfy anyone for a very long period of time. And here's my take on this. If tech can do it, then I'm not hiring. Then I'm not hiring. Why? People have problems, man. People have demands. People have expectations. I'm a business owner. I'm looking out for my business. I'm looking out for how things work in my case. Everyone's looking out for themselves. If you're a smart employee, then you're looking out for yourself, and you should be. If you're stuck to your business thinking that they are your friend, let me tell you, I've got news for you. They're not. They're going to let you go as soon as they find that they don't need you. They're going to let you go. So whether you're an employee or an employer, you are in it for yourself. Everybody goes to a workplace to make things better for themselves. Therefore, you have no obligation towards an employer if you're an employee outside of what your contract is, and your employer does not have an obligation to you outside of that contract. By the same token, if you're an employer, you don't have any obligation to your employee outside of the contract, and you can let them go. If I have, and I like people, I love helping people, but at the same time, if I can save $350,000 by firing 3 people, 3 coders, and instead just spend $20,000 a year on agentic coding, that I'm doing that. I'm just going to do that. Or, replace them with a single $250,000 employee who can help me with agentic coding. I'm saving the $100,000. I really am. And that is where people are wrong. You're stuck in the 2008, 2005, 1995, 1955 methodology where people are equivalent to scaling, and that's absolutely not true. We are looking at businesses. I remember this guy, but I forget his name. He runs all these different websites that he's created for himself. He's got $30 million in revenue. Most of that is take home, so 90% plus of that. Now, I may be wrong here. And this is a famous person. So if you're on Twitter a lot, you probably know this guy, right? 90% of that or more is his take home thing. And he's a solo operator. He's absolutely solo in this thing. He's using AI for coding. He's using technology to solve all the problems that his customers have. He's got a whole tech stack. Maybe he has a few freelancers for customer support. I don't know. But what we do know is he's taking away 90% of that. And how is he doing that? Well, by being solo, by using tech. We already know AI kills jobs. This is not news to anyone. You're looking at this every day. In every live stream, we talk about how AI is killing jobs. And, good or bad, the world works the way it works. Not the way you think it should. Let me say that again. The world works the way it works, not the way you think it can, or the way you think it should. If you are smart, you're just going to adapt. The fundamental theory of evolution was the most adaptable are the ones that survive the longest. Can you adapt to the changing business environment? And right now, the business environment is pivoting to people just losing their jobs because of AI, because AI is just better. Would I spend $20,000 on a piece of code? Let's say I wanted a plugin made for one of my businesses, right? That enables a certain functionality for me or for my customers. Well, if I can get a bunch of quotes, someone quotes me 10K, someone quotes me 25K, and someone quotes me 50K. Well, first of all, I'm not very happy with the 10K quote. You know why? I don't trust them as much as the $25,000 guy or the $50,000 guy, or the $25,000 team or the $50,000 team, because if you're worth your weight in salt, and if you're worth your salt, and if you're going to solve my problems that I really have, and that is going to unlock hundreds of thousands of dollars in extra revenue or time saved or expenses saved, then $50,000 is worth it, $25,000 is worth it, $10,000 is also worth it, but I don't really trust it that much. Yeah, and that's how a lot of your customers think. So brings me back to this whole thing that we were talking about. Hey, should we fight inflation without increasing prices? No, you shouldn't. You really should be striving to be the highest cost solution in your marketplace while still being able to justify the value delivery in the process. If you can deliver value at 5 times higher price points than your competitors, you are in a great position. And if you're in a position where you are worried that increasing your prices by 30% is going to actually get rid of your clients or your clients firing you, then you are in a really bad position. I know, because I was there. A few years ago, a great client of mine, 10-year friend of mine, right? Someone I considered friend, who had tens of thousands of dollars worth of credit from me. They literally just stopped working with me because I wanted them to actually have a 10 to 15% increment in the monthly contract. It was a flat fee contract, and that was a great big eye-opener for me. I'd been preaching all these principles instead of implementing all these principles, and they thought they could run their business without our particular services just as effectively, and you are replaceable. That's always true. Even if you're offering something that is completely unique and you're not going to have a lot of competition in the market, you're still replaceable. At the end of the day, everyone is in it looking out for themselves. So what does that tell you? Well, if you can let go of people, you should. You know, that's what it's telling us. If you can let go of people and use AI or tech stacks to actually enable service to your market, that's your first and foremost goal with your business, then that's it. Just do that. And finally, tariffs are the new taxes. You have to stop complaining because the world works the way it works, not the way you want it to. So if tariffs are going to happen, might as well accept it. Accept the uncertainty. Why? Because this uncertainty and the acceptance of it positions you head and shoulders above your competition and your competitors. Why? Because they're worried about it. They're trying to respond to it. You're just really ready. It's like being someone who's okay with Bitcoin going up or SPX going up or gold prices going up, or Bitcoin going down and SPX going down and gold prices going down. For me, if Bitcoin goes down to $40,000, it's great. I buy a bunch more. If it goes up to $250,000, great, we sell even more. We lower our position at that point of time. The headwinds and tailwinds are going to continue. We're never going to be able to predict what's happening on a day-to-day basis. The short-term noise is always going to be there. But our job is to keep our cost basis low. That's really our long-term prediction for Bitcoin, and we will be wrong. Same thing with SPX. Long-term, I predict SPX is just going to go up. You can quote me on that. Can I be wrong over a year? Yes. Can I be wrong over 5 years? Unlikely. Can I be wrong over 50 years? No. Unless the world economy fails catastrophically, SPX is going to go up over 20, 30, 40, 50 years. It absolutely will. You can quote me on this. Come back to this video 10 years from now and comment down below that, oh, you know, you were wrong. SPX went down or Bitcoin went down. Let me know if I was wrong. Come back to this video in 2035. So how do you profit from this uncertainty? Taxes and tariffs. I mean, I consider tariffs as the new taxes, right? You have to deal with them no matter what. So how? How do you deal with them, especially if you're importing stuff from, because for our e-commerce businesses, some of our e-commerce businesses, for me and my clients, we do import a lot of goods from China, for instance. So how do you accept the uncertainty? Well, we don't know what's going to happen. The tariffs could go up, tariffs could go down. We just accept that and we start profiting. How do we do that? By focusing on KPIs. The KPIs that really matter to us are cost of goods sold, top line, customer acquisition cost. Now, this is unique for our businesses, okay? This may not be completely applicable to your business, but you also have the same costs, and also you have fixed costs, yeah? For instance, your lease. If you have your lease, you have cost of goods sold, you have your top line, which is your revenue, and your customer acquisition cost. The only thing that is affected by the tariffs, these are the tariffs, the only thing it affects is your cost of goods sold. That's it. So tariffs, so I'll give you an example. Let's say you're selling something for $100. Okay, this is a hypothetical example. It does not represent my products, but I'm just going to give you an example that makes sense. If that's your product price, yeah, and you break it down as such, your cost of goods sold is $30. Your customer acquisition cost is $25. And your fixed costs are, let's say, $10. Okay, so what's your net profit here? Your net is 100 less 30 plus 25 plus 10, which is $35, right? You're making $35. Now, if cost of goods sold goes up, so tariff takes this from $30 to, let's say, $40. Just as an example, this goes down to $25. Well, the way to counter that is by A, increasing your prices. So increase your price to $110. So this remains at 35. You can also try to fight this by trying to lower your customer acquisition cost, which is hard but not impossible. You can try to negotiate a lower lease for your thing or move to a cheaper area. This is just a, how would I say, a short-term solution for a long-term problem, okay? So I really don't recommend this. I recommend this anyway because that's just money saved, goes into your pocket. The only reasonable long-term solution, however, is just increasing prices. I'm just a huge fan of increasing prices because that's really what the government wants, right? Increase the prices because we want inflation. We don't want deflation. We want GDP to go up. So here, instead of contributing $100 to the GDP every time I sell a widget, now I am contributing $110 to the GDP every time I sell a widget. And also the tax revenue also goes up because sales tax are a function of the selling price. There's no way to avoid that without worrying, without getting crushed by this fight, okay? Now tariffs go up, tariffs go down, and if tariffs go down, you're free to decrease your prices, but I really wouldn't. If customers are buying from you at the new price, why would you want to decrease your price? In fact, that's where the principle of price elasticity comes into picture. Price elasticity is all about testing, as far as I understand. Okay, for me, it's all about testing hypotheses. And what are we testing here? Testing how much the market pays, because the market decides what your product is worth. If you ask $10,000 for used boots, is someone paying? Probably not. Why? Because the market decides what those used boots are worth. If you wanted $25 for them, maybe someone would. If these are used boots worn by JFK, however, they probably might even go for $10 million. Why? Because the market decides how much any product is worth. And that is the essence of price elasticity for me. It's not the economic model of, oh, here's the supply, here's the demand, and this is where they meet. That's a simplistic reduction of how price elasticity works. That works for commodities, not for brands, not for products that are actually scarce. Most products are fungible, which is where this works, this model of demand and supply. Actually, this model always works, but this also depends upon how scarce the supply is. It also works on how scarce the supply is and how invaluable that product is, or how valuable that product is to the buyer. So market is going to tell you the absolute truth about your positioning, about your price, about your product and its value. Let the market tell you what your product is worth. If it's selling well at $100, might as well test it for $150 and then test for $200 and test for $300, because what are you really optimizing for? The KPI that I optimize for is bottom line, not the top line. I don't care if the top line goes down, but the bottom line goes up. At the end of the day, if you're a small business, the value of your business, the equity of your business is proportional to the EBITDA produced by that business. Earnings before interest, tax, depreciation, amortization. The value of your business is a multiple of the EBITDA. And that's really all I care about. Why? Because A, that's what I get to take home after taxes, and B, that's the value of the business. That's how I maximize shareholder equity, which I'm generally the largest shareholder in my own businesses. And even for other clients that I work with, they want their business to have maximum value at the point of sale, and that comes from equity value, which is a proportion of EBITDA. Generally, top line only really works for pre-revenue companies or extremely innovative companies, and if you're one of those, you already know what we're talking about here. So what all that to say, test out higher prices. Look, let me give you an example. Let's say you increase your price in that same example from $100 to $500. Sounds insane, right? Sounds insane. Well, the market says, yeah, you know, the rest of the costs remain the same. So your COGS is still whatever, 40 bucks, yeah, with the tariffs. Then your fixed costs are still 10 bucks. They don't change. Your customer acquisition cost, which used to be what? In that example we had, the customer acquisition cost was 25 bucks. So this goes up to, from 25 bucks, yeah, this was 25 bucks. It goes to, I don't care, 250 bucks. So now your conversions are 10 times as expensive as they used to be. But look at the amount of money you're making. So you were making what? 25 bucks here. And now what are you making? 210 bucks per sale. In other words, your business is actually stronger. Now, your EBITDA is significantly higher as a proportion of your revenue compared to what it was here. And you can also afford to pay even more to acquire that customer. That's the other thing that people don't talk about. Can you pay more to acquire a customer when your margins are thin? No. Can you pay more to acquire a customer when your margins are fat and juicy? Yes, you can. So never worry about increasing the prices of your products and testing the market. In a lot of cases, your positioning is weak simply because you are afraid of framing your product the correct way. If your product delivers the value, you can always go up in price, in a lot of cases, a lot higher than you think. Now, if you're just selling commodities, it's probably not going to work. If you want to sell me gas for 10 bucks a gallon, it's probably not going to work. But here's something I'll tell you. Years ago, I went to Costco to get gas, and there was a line. There was a queue, right? Queue of vehicles that wanted gas at Costco. Why? Because it was like 10 to 20 cents cheaper than anywhere else. And then I wasted 4 hours because I saved $4 on tank of gas. That was the last time I did it. Now, when I look at the map and I try to figure out where I can get gas, I find the location on my way, so I don't really have to go out of my way. Saves time. And then I also try to optimize for the most expensive one because the price difference is really like 20 cents, 30 cents a gallon. And so when you're paying $5 extra, okay, but you're saving 15 minutes driving to, and then another 10 minutes in the queue, you saved yourself 25 minutes. So unless you're making minimum wage, you're just doing a positive thing by actually buying more expensive fuel. What that means is that there is even some price elasticity for commodities like gas. They're exactly the same from one. Like the premium gas at Costco is the same as premium gas at Shell, at Cisco, wherever, you know? If you can get gas at the exact same price, but it's shorter queues, would you take it? Yes. But in my case, I would rather pay more. And your customers might have different things that they value. They may value the experience. They may value the comfort. They may value the status achieved by using your product. It's really up to your positioning, how you've set up your positioning and how your product works for them. They may value the time saved. They may value the money saved. Look, as I always keep saying, in business, people are not in it for you, they're in it for themselves. Whether it's your customers, your clients, your employees, your friends, your suppliers, everyone is in the business market for themselves. They're all looking out for themselves. And if your product costs a lot of money, but then delivers more value than the amount of money you're charging, people will pay it. Not everyone will, but some people will pay it. That is where the value potential comes into picture. If there's value, people will pay. That's it. That's all you really need to know. So with that said, we come to the end of today's live stream. I hope you had fun and you learned something from it, or you disagreed with something in it. And if you did disagree with something, leave a comment down below. If you actually gained some insights that you can apply to your business, I would love it if you would leave a comment down below and let me know how you're going to apply some of what we discussed today into your business. So, are you already using AI in your business? Or is it the opposite of a moat where your competitors are using it, but you're not? Are you actually able to take advantage of price elasticity because you offer so much value and you're not really selling a commodity? Your product is packaged up and designed in a way that it solves problems that your customers have that they cannot easily solve with other people, with other competitors that you have. And if not, how are you bringing your product from a commodity status to a branded product status, which is essentially saying, oh, this does something that others cannot? How are you doing it? And it's mostly perceived value that you have to worry about, not just objective value. Okay? My name is Laksh Behl. I had great fun talking to you over today's live stream, and I'll see you in the next one.